Ever wondered what financial instruments are and how they work? If so, you've landed in the right place. Financial instruments, albeit a somewhat complex term, are fundamental elements of the financial markets, and they play an integral role in the world economy. So what exactly are they? In simple terms, financial instruments are contracts or agreements that can be traded and that give a right to a financial asset or equity to their owner. They come in various forms such as stocks, bonds, futures, options, amongst others, each with distinct characteristics and functions. Stocks, for example, represent ownership in a company, and they offer the potential for profit through capital gains and dividends. Bonds, on the other hand, are a form of debt issued by governments or corporations to raise capital. These financial instruments are the gears that keep the economic engine running. They provide avenues for investment, they facilitate money and capital markets, and they help companies to expand and grow. They are essentially the lifeblood of our capitalist society. Understanding how they work, however, is not a straightforward task. It requires knowledge of financial markets and principles, as well as a keen understanding of economic indicators and trends. But don't fret. Our mission here today is to shed light on these complex financial mechanisms and to provide you with a comprehensive understanding of their workings. So, whether you're a seasoned investor or a finance newbie, you're sure to find something of value in our exploration of these powerful tools. Well, sit back and relax as we delve into this fascinating world of finance. Financial instruments can be broadly divided into two types: cash instruments and derivative instruments. Cash instruments are those whose values are directly determined by the markets. They can be securities that are readily transferable, such as stocks and bonds. Cash instruments can also take the form of deposits and loans agreed upon by borrowers and lenders. A prime example of a cash instrument is a check, which facilitates the transfer of payment from one bank account to another. On the flip side, we have derivative instruments. The value and characteristics of these instruments are based on their underlying components, such as assets, interest rates, or indices. Consider an equity options contract, say a call option on a particular stock. This option is a derivative as it derives its value from the underlying shares. The call option provides the right, but not the obligation, to purchase shares of the stock at a specified price and by a certain date. As the price of the underlying stock fluctuates, so does the value of the option, albeit not necessarily by the same percentage. Financial instruments can further be categorized according to their asset class, which can be either debt-based or equity-based. Debt-based instruments are essentially loans made by an investor to the owner of the asset. Short-term, debt-based financial instruments last for a year or less and come in forms such as treasury bills and commercial paper. Long-term, debt-based financial instruments, on the other hand, last for more than a year and are typically issued as bonds or mortgage-backed securities. Equity-based instruments, however, represent ownership of an asset. Stocks, which can be either common stock or preferred shares, are the most common equity-based financial instruments. ETFs and mutual funds can also fall under this category. We also have foreign exchange instruments, which include derivatives such as forwards, futures, and options on currency pairs, as well as contracts for difference. So there you have it. Financial instruments come in numerous forms and types, but their common characteristic is that they confer a financial obligation or right to the holder. So next time you're navigating the financial world, you'll have a better understanding of the tools at your disposal.